is purely mechanical, but sometimes these concepts will simply fail. And the reason goes back to what was said earlier. There are other battles going on in the market beyond the smart money versus the retail traders. These other battles simply don't care about market structure, but their actions will be reflected in price, therefore disrupting these notions of market structure sometimes. A very simple example of that is when a commercial trader, which is considered to be the highest tribe of smart money, since they have access to primary market information, decides to use the financial market as a hedging mechanism rather than a speculative one. This will usually involve a hedge where the profit comes from the difference between derivatives and the underlying asset, not from the notion of buying low and selling high. This trade, which is often massive, will be reflected in price action, but it will disrupt all these notions of market structure we are learning because the market player behind it simply doesn't operate under that logic. I have a video here in the channel demonstrating exactly how that works if you're interested, and it serves as a good primer for the world of derivatives trading. Another detail here is that sometimes a false breakout is not what it seems to be. False breakouts are not always the result from predatory practices in the market, and once again, it is impossible to know when it is simply by looking at a price chart. False breakouts feel like manipulation, but they are often misinterpreted symptoms of deeper market mechanics, not necessarily malicious intent from bigger institutional players towards retail traders. Retail traders assume all false breakouts are engineered, but in reality, many of the false breakouts are failed auctions, which means a lack of follow-through interest, inventory shifts, which is when a market maker is hedging risk, mutual funds and asset managers rebalancing portfolios, and news whipsaws, meaning a sudden repricing of macro expectations. Recall that the price chart is the tip of the iceberg of the market. It shows the outcome, but it doesn't show the intent. It shows the effect, but not the cause. It shows the price, but not the purpose behind it. Because price is an incomplete source of information, there is a limit to how much you can infer from it. Different market players coexist, interact, and intersect, but these market players don't operate under the same logic. Speculators, arbitrageurs, and hedgers will intertwine and disrupt basic notions of price action and order flow. When these notions of price action and order flow fail in the chart, you'll start looking for the answers of why that happened. But the problem is that the answers don't dwell in the price chart. That also means that market structure, supply and demand, order flow, and liquidity concepts are not a perfect science despite being very helpful. The answer is not looking at other time frames. It's to understand the modes of action of the large market participants that impact price action, but that don't use price charts at all. Let's now see some examples of trading using liquidity concepts using real price charts so you can have a better idea of how this plays out in the real world. The first example is in the 1-hour chart of the S&P futures. Price creates a break of structure to the upside, and that automatically renders the low that originated the movement as a strong low. It's at this point that we draw a demand zone in this case, which is an area right above the strong low. Recalling that right below the strong low, we have a liquidity pool. There are many ways of drawing supply and demand zones, but one quick way is to simply highlight the range of the candle that forms the strong low. We are going to dive deeper into institutional supply and demand zones in another video. What matters to us in this case is the fact that both the range and the pullback have rough market structure, and therefore, minor liquidity pools along the way that allow the smart money to get to the upside without violating the demand zone and the strong low. Notice that one of the minor lows in the range coincides with a minor low in the pullback, creating a stronger liquidity pool. When price violates the lowest minor liquidity pool inside the demand zone, it snaps back up again. This is the false breakout that we as retail traders looking at price charts have to assume is the result from the smart money inducing retail traders to the downside, just so they can enter with large, long positions without consuming a large price range. Given the two liquidity pools above the strong low, the smart money has enough liquidity to drive the market to the upside without breaking the strong low. That's the basic intuition you need when thinking about liquidity concepts in the paradigm of smart money trading. Let's observe now an example where this idea of liquidity inducement simply doesn't work and the things you must pay attention to in order to prepare for that. Take a look at this 4-hour chart of gold futures. Here we have a smooth range and a relatively smooth pullback as well. If you think only in terms of liquidity inducement to feel the significant moves, you'll miss the point. Because market structure is smooth, there are no significant liquidity pools within the range and pullback in order to provide enough fuel for the smart money to drive the market up. That leads us to think that price should break the strong low and then move upwards, but that's not what happens. Price pulls back, stops above the strong low, and then continues strongly to the upside. What you must remember here is that price doesn't follow liquidity, it follows the perception of value. It will revisit areas of fair and unfair value of the recent past and get attracted and repelled from these areas. If we look at the footprint of this upward price movement, you'll see that near the strong low, there is a large stacked imbalance in the S column, and right below this stacked imbalance, there are two consecutive high volume nodes. If we mark this area and extend it to the right, we get this: the precise range where price resumes to the upside. This level seen in the footprint represents a level where buyers produce the most aggression, so it serves as a more precise demand zone. The type of supply and demand zone you draw depend on the market structure of the price movements involved. But like I said earlier, we'll dive into supply and demand under the smart money trading paradigm in another video since it's a big subject. The lesson here is the one we saw in the beginning. Price does not move towards liquidity. Price moves towards perceived value. Liquidity is simply a mean through which that happens. You must contextualize that with the limitations of the price chart and the complex landscape of market participants that shape price action. Hopefully, this video gives you a more sophisticated and realistic view of liquidity and how it fits into the financial market. Subscribe to the channel, activate the notifications, leave your feedback below in the comment section, and share this video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.